What's happening in Japan right now is really interesting because this is no longer simply a US rate story that's driving dollar yen higher. The shape and speed of the move in Japanese government bonds is beginning to send a much broader signal about inflation, fiscal sustainability, and Japan's vulnerability to prolonged disruptions in global energy markets. If we start with this first chart, the blue curve shows where JGB yields were trading the day before the Iran war began in late February. The green curve shows Friday's closing level, while the yellow curve reflects where yields are trading now. The key takeaway is the aggressive bear steepening that's developed over recent weeks. Yes, yields have been moving higher across the curve, but the acceleration further out is what really matters on this occasion. It's important because if this was simply a clean repricing of BOJ rate hike expectations, you'd normally expect a flatter curve structure as short-end yields rise relative to the long end. Instead, investors are demanding additional compensation to own longer-dated Japanese debt. If we look at the second graphic that shows BOJ pricing based on overnight index swaps, markets already had a pretty hawkish BOJ profile embedded well before the latest acceleration in long-end yields took place. June is nearly 80% priced for a hike, while almost 2 full moves are priced by the end of this year. So the recent move in 10s, 20s, 30s, and even 40-year JGBs cannot simply be explained away as markets suddenly waking up to the possibility of the BOJ hiking rates. It was already there. And that brings us to the next chart showing the individual moves by tenor. The sell-off further out the curve has become increasingly disorderly over recent sessions. Now, some caution is needed because liquidity conditions in super long JGBs can become very thin, exaggerating the size of moves, especially when volatility increases like we're seeing today. But even allowing for that, there's still a broader signal emerging around inflation risks, fiscal concerns, and Japan's external vulnerability if energy market disruptions persist. Japan remains heavily dependent on imported energy, meaning prolonged strength in oil and gas prices risks worsening both inflationary pressures and the current account position simultaneously. In practical terms, more yen may need to be sold to pay for imported energy at the same time that Japan's inflation outlook is deteriorating. And I think this is where the story becomes really interesting because markets increasingly appear unwilling to allow both the yen and long end of the JGB curve to remain simultaneously protected. If we jump to the daily dollar-yen chart, suspected intervention activity from Japanese authorities earlier this month temporarily disrupted the uptrend. But the broader macro regime quickly reasserted itself with the pair now knocking on the door of 159. Importantly, while FX volatility was temporarily suppressed, stress almost immediately accelerated further out the JGB curve. So rather than eradicating the pressure, FX intervention may have simply shifted where the adjustment was taking place. That creates a difficult balancing act for Japanese policymakers. If authorities tolerate rising long-end yields, concerns around debt sustainability will almost certainly intensify. But if the BOJ leans harder against bond market volatility, either through heavier bond purchases or unscheduled operations, the pressure release valve may shift straight back onto the yen, especially with the broader macro backdrop still favouring yen weakness. Best of luck with your trading. I'll catch you next time.